Welcome everyone to this episode of Peak Market Watch. We speak with market leaders in commercial real estate and related services, and everyone who has a close pulse on the current market environment. My name is Anton Mattli, co-founder and CEO of Peak Financing. Today, I'm honored to welcome August Biniaz, who is the co-founder and chief investment officer of CPI Capital. Welcome, August.
Thank you for having me. The honor is all mine.
Yeah, great to have you on. We have now crossed paths for a number of years on various events in the multifamily space. But why don't you introduce yourself a little bit to our listeners so they have a little bit of a background about you?
Yeah, of course. August Biniaz with CPI Capital. I'm the chief investment officer with CPI. CPI is a boutique real estate private equity firm. Our asset class that we're focused on is multifamily. The business model is value add. The regional focus is Florida, particularly focused on Jacksonville and Tampa, the more workforce housing type of demographic that we focus on. And what really sets us apart from other investment groups, real estate private equity groups, is that we were originally headquartered out of Canada, the West Coast, Vancouver, Canada, partnering with Canadian LPs to acquire U.S. multifamily. We have now, started a branch in the U.S., so based out of Southwest Florida and Naples. So yeah, what sets us apart that we partner with both Canadian and U.S. LPs to acquire our assets. We're also really big on education. You talked about us meeting at many different events, so I've always taken the opportunity of interviewing you every chance I get when I frequent some of these conferences and events, and very active on LinkedIn as well. We've spoken, chatted many times on each other's posts. But yeah,
definitely, yeah. So obviously, many are very familiar with investors from the US and the structures that are putting in place for US-based investors. With Canadian investors in particular, there are some differences. So maybe if you can give a little bit of an overview of where the differences are and how you have been able to overcome those.
Of course. I mean, as soon as a lot of investors, be it real estate investors or other investors, hear about compliance and the SEC, it gives them shivers because it is pretty convoluted and complex, and you have to follow the guidelines and regulations, and it's a pretty rigid organization and rules you have to follow. Now, imagine having to follow multiple security commissions and regulatory bodies. And the reason I say multiple is not just the SEC, because in Canada, depending on each province, our version of the state you're raising capital, you have to adhere to that province's regulatory framework and compliance. So makes things very complicated on the security compliance of things when you're raising capital from Canadian or international investors for a US-based syndication. And then the other very important point is also tax efficiency as well. You want to ensure that your investors are paying their taxes in the US, but that whatever country they're investing from, be it Canada in our case, that the tax agency, in our case, the CRA, Canadian Revenue Agency, recognizes the taxes that were paid on the US side and doesn't double tax the investors, which seems to be a very common issue that a lot of syndicators have when they bring on international investors. They're not structuring the deals in the right way and they're getting double taxed. But yeah, as far as complications, definitely complicated. And that's why there's really a handful of investor or investment firms that focus on partnering with Canadian LPs to acquire US real estate. And that's where we saw that there was an opportunity for us to build a firm that focuses on Canadian investors. But then we realized there's lots of US investors looking to partner with us as well. So we put our attention and focus on US investors as well.
Yeah, very good. So obviously, once you build yourself a track record and you're in the market, people learn about you, and the investors in the US have an interest with whoever is a good operator, regardless of where the original investors came from, right? So with the Canadian investors, I think a lot of these hiccups that we have seen in the past, that in the US you typically have that LLC structure. and then they brought in Canadian investors, and then suddenly realized, oh, we have an issue here. So maybe you can touch on that LLC versus the partnership.
Absolutely. LLCs.
Yeah.
Absolutely, LLCs have really been the structure that is the common structure to be used. They're really been made sexy by a lot of corporate attorneys and CPAs, but we don't even have LLCs in Canada. So you either have a corporation or you have a limited partnership. Historically, a limited partnership has been the entity that a lot of funds or larger private equity firms like Blackstone, they use a limited partnership, not really LLC. LLC is really a hybrid entity that has certain tax benefits and certain protection benefits. But in my opinion, the correct entity to use is a limited partnership. Now, so if LLCs are used, that's not tax efficient because Canada doesn't recognize an LLC as a flow-through entity. So any taxes paid on the property level or on that entity level are not being recognized by the Canadian tax regulators. So, but when we also noticed that we were getting a lot of pushback, not only from our attorneys, not only from our U.S. Tax accountants, but we were also getting pushback from our lenders because they were just so used to using LLCs. And as soon as we say, hey, we want to use a limited partnership, it was causing some issues. A lot of times lenders require that the asset that owns a property be at a single member entity, that there isn't a multiple investors involved in that entity, because they don't want to go and be involved in a lawsuit in case of a default, between the lender and many investors. So they want it to be a single member entity. How are you going to create a limited partnership with single member entities? So we had to get our tax advisors and tax attorneys to create a limited partnership that we ourselves are the limited partners and the general partners in that entity. And then we had other entities along the way that allowed us to bring on our both Canadian LPs and US LPs. And then, taking that even farther, another pain point that our Canadian investors had was the need to have to deal with the IRS. As a newer firm, as I mentioned, we were a boutique firm, not having a long track record when you're connecting with investors, no matter how well you've performed so far, because you're a newer group, newer firm, new idea, they're really going through everything with a fine-tooth comb. And they're really getting on those investor calls with us, just finding reasons not to invest, but rather to invest. So they want to see, does this make sense? And the more difficult, the more convoluted the process, the confused mind always says no, right? So what issue that we were facing early on was that we were requiring our investors to apply for an ITIN number or an EIN number if they were investing through a corporation, and they had to file taxes every year with the IRS, which was another hurdle they had to go through. And then on top of that, any type of returns that was coming to them, our average check size is around 115,000. Mm-hmm. So those tax filings, the cost of the filing was eroding away their, a portion of their distribution as well. So when we sat down with our cross-border tax advisors, we wanted to come up with a strategy where our Canadian investors didn't have to file U.S. taxes, that they didn't have to deal with the IRS, that they were the structure was tax efficient, that they were not double taxed, that we were able to bring on Canadian LPs and US LPs. And we were also able to bring on co-GPs or joint venture general partners as well. So that's what we went to our team with. And we said, this is what the structure we want you to create for us. And they went and created the structure and actually drafted a tax memorandum for us to be able to, have all the bells and whistles we needed.
Okay, so you have that in place now?
Exactly, we have that in place. Our first two deals that we did, investors did have to file U.S. taxes. On our last deal, which we've done now 18 months ago, a year and a half ago, and we can talk about why such a long delay between doing deals. It was structured in a way that the investors didn't have to file U.S. taxes, that our firm was doing the taxes on their behalf.
Okay, so is that because you structure it more like a fund, or how is it from a legal perspective? How did you structure it differently that you were able to
Yes.
achieve that?
No, it's still structured as a syndication. So it's basically, if you want to imagine that, is a project specific fund. So not only the deal is syndicated on the U.S. level. So imagine a limited partnership on the U.S. level that owns the property, that has multiple limited partners and a general partner. We also have a entity on the Canadian level, a limited partnership in Canada. So the Canadian investors invest in the Canadian limited partnership.
Okay.
The Canadian limited partnership invests into a U.S. limited partnership. But we also had to create to be able to file the taxes on behalf of the investors and them, Canadian investors, and them not having to file for taxes individually. We had to also create blocker entities and more of a complex. If you see the org chart that our accountant have put together, is really, it's pretty complex, really.
So the Canadian partnership essentially files then one tax return in the US.
Exactly, on behalf of the individual investors.
Yeah.
It's a little bit more complicated than that, but that's basically
at the high level, sure.
Yeah, it's high level.
Very good. So, and you still achieve that pass-through tax benefit, which is obviously the key piece for them, right?
Depreciation, you mean?
Right.
Yeah. So again, it's getting again complicated a bit. So we've been working with our tax advisors on achieving the highest amount of depreciation for Canadian investors. Unfortunately, CRA only recognizes 4% depreciation per year. So the types of 80% paper loss year one, the bonus depreciation, cost segregation strategies could not be fully utilized for Canadian investors, but we're working with our tax strategists, and we're able to achieve more than the regular 4%. But again, it gets a little bit more complicated on how we've achieved that.
Sure. Yeah. What about the recapture then? Obviously, that is on the US side, particularly when you take a massive bonus depreciation. You also will be faced with a big recapture issue. Do you have a similar structure in Canada where you also have a recapture element?
I don't believe you have a recapture when it comes to that 4% depreciation per year. But again, it's pretty complicated items, and we're in continued discussions with our tax professional.
Okay. Yeah, very good. So congrats that you were able to achieve that. Right. This is generally speaking, it's a challenge for overseas investors, whether it's from Canada or out of the US investors, when you have to come up with a EIN, when you have to file taxes. Obviously, if you bring in a larger check like 500,000, $1 million, then it's doable, right, from a cost perspective. But if it's a $75,000 or $100,000 investment, then it's very costly when you have to go through all these tax filings just in the US on top of what you already then have in your home country. So congrats on achieving that. That's great. So on the investment side, you mentioned your target is Jacksonville and Tampa primarily as the two markets. Florida has been in the news quite a bit on the insurance side. Obviously, most of the news always comes on the single family side, but as we know, multifamily also has challenges on the insurance side, including Florida. So how have you been able to deal with that issue?
Yeah, I mean, the insurance costs have gone up in some cases 400% here in Florida. There's also some areas in Texas as well, coastal areas in Texas. But we're underwriting on on the basis of the new insurance cost. So that's what we're putting into our underwriting model. We're trying to be creative in some cases. Some strategies we've utilized is talking with some property managers in the regions we're in that we're interviewing to manage our properties and bringing on their umbrella policy, their blanket policy to get the better rates. The other strategies we've spoken about and discussed and I've actually tried to implement is working with the seller who has a large portfolio and keeping them on as a minority general partner stakeholder and keeping their policy on the property to make those savings. But this is an issue not only being faced by us, is also being faced by investors that have larger portfolios. Their insurance costs are going up as well as soon as the time comes for renew. So is a factor that we're taking into account, and we're underwriting as those bases, and it just makes our argument better when we go in. And there's been a disconnect between sellers and buyers. Sellers are still hoping to achieve the prices that we're achieving in 2021 and early 2022, and when they were able to get sub 4 cap rate on their deals, and they're seeing the same deal now being traded at 5.5, 6 cap in some cases. So that could be in the millions of price difference. So that's the hardest part, is when a seller is seeing that, and especially sellers who are not in a position that they need to sell, and their properties are cash flowing, and they got a decent type of debt that they locked in earlier on. They have no motivation to sell. So if the deal is coming to the market, and this is what we've noticed, that when we're going in and writing offers and making it to the best and final, and we're not being awarded the property, one of our strategies is to get back in touch with the broker and find out what happened, and try to extract as much information as possible. And we're finding out that 60% of the deals that we were involved with, the seller actually decided to take the deal off the market, that the deal never traded. So that tells us that in some cases, the seller is basically not in a situation that they want to sell. They're testing out the market, see what kind of price they can get. And, they're not as enthusiastic of a seller as others.
Yes, definitely. Right. I would say right now they are mostly forced sellers that are willing to sell. And even the ones that have an attractive in-place loan that can be assumed, I would say with a lot of them, at least from what we have seen over the last 6 months, is that the brokers present them with a BOV, right, broker opinion of value, which has a certain price attached to it. And unfortunately, with every month that has passed from that point on, cap rates moved up across the market. And unfortunately, once you hear a certain number from the broker and then the offers come in significantly lower, you're so attached to that initial number as a seller that you are, unless you're forced to sell, you probably say, well, that's not worth it for us. It's
Yes. No, great point. And that's another thing we're recognizing, is that historically, the whisper price and the majority of offers are very close, maybe just by a few percent. But now we're seeing almost as 20% difference in our underwriting price and the price that we're willing to pay for a property and the whisper price. And, in our director of acquisition, Paul Hopkins, is having conversations with these brokers, and they're saying, no, that's fine. Go ahead and bring in your offer. We'll still entertain it at 20% below whisper.
Yeah.
So that's been another surprising part of this whole situation.
Yeah, it's a very good point, right? And obviously, brokers always they're brokers, right? So their job is to maximize the sales price for the seller. So we understand that. I think they are put under so much pressure also from the seller side and to fill their own pipeline, that you're willing to go out with that high whisper, but also communicate to their sellers, look, yes, we go out with that number, but it's not really realistic, right? So I think that's why they are willing to accept these offers that are significantly below the whisper price. No, the brokers do not really believe that whisper price is realistic, but the sellers still ask them to go out with that number, right?
Yes.
So unfortunately, that's always like that when prices go the other way, right?
Yes. And also keep in mind, in Jacksonville and Tampa over the last year or two, over the last couple of years, the rent increases have been astronomical, going up in almost 30%. So when you've had such a bull run and you have a slowdown in the market, what's happening with the debt markets, what's been happening with the equity markets, the investor sentiments, what's happening overall with the economy, what's happening in geopolitics, what's taking place, around the world, affecting the U.S. It really affects it, in a macro way as well, right? So both as far as the buyers and the sellers. So very interesting times we're in. But some of the deals are really still trading in some cases. And what we're seeing with those deals that are trading, again, we're doing analysis and seeing, hey, how did this deal make sense that was purchased 10% above our price? How is that possible? How could we come in at 20 million and somebody else was willing to pay $2 million extra for this property? And what we're seeing is this is basically in the single digit returns to their LPs if they were to syndicate their deals. So we're understanding that most probably they're either not syndicating the deal, they have some dry powder, they need to make some allocations, or they have cheap cost of equity and they're getting involved in these deals. There was a purpose for them to get involved in the deal, or they're just being much more aggressive. I'm sure, as you know, a small change in the numbers and the calculations in the underwriting model could affect the purchase price by millions of dollars. What we're noticing, for example, currently we're underwriting to a 3% annual rent growth. Our first year we're putting it at 1.5%. Our exit cap, we're putting it as when we get our CoStar report for our current market cap for the property, we're adding 10 basis points per year on top of that. So if you're holding it for 5 years, that's 50 basis points above the going in CoStar going in cap or the market cap. And those are the numbers we're getting. And when we go in there and we say, hey, if you change this just from a 3% rent growth to a 5% rent growth, and you make your exit cap just 5 basis points per year, then you can achieve that extra number. So it also depends on how seasoned, how experienced the group is that are syndicating deals, what school of thought they came from. Some of these coaches and mentors teach the 5% rent growth, which was achievable over the last 10, 12 years, but it's not going that way right now. So again, very interesting times.
Yeah, absolutely. Right. And you touched on the cap rate, right? It has such a massive impact depending on where you pencil that in for your exit, right? As we have seen, right? So as we see right now, once you have a significant move in cap rates, how much of a value destroyer that can be. And naturally, if someone has a little bit of an aggressive stance where they feel that cap rates will stay low, then they can be more aggressive with their offer, right? Unfortunately, nobody has that perfect crystal ball, so they might be right, right?
Yes.
But once you have investors' money, you better have enough cushion that if you are wrong, that you still can absorb that assumption mistake, right? And fortunately, particularly with cap rates, we talk immediately about the millions of being apart, right? So that's the dangerous part.
Exactly. Yeah. Great point.
Yeah. So what about property taxes in Jacksonville and Tampa? Have the county appraisers have they pulled back with their aggressive assessment increases, or do you still have a battle there?
We do. We use a third-party service provider that actually goes to fight for us with the county and on the taxes part. Again, we underwrite with those numbers that we get from our advisors before we go in and making an offer. I haven't seen it as a big issue or big topic of conversation with us and our acquisition team.
Okay, very good. Now, another topic that's on everyone's mind, obviously, is our interest rates and the bridge loans that are all coming due over the next 2 years, right? Some, the ones that were taken out in 2021, that come due next year. The ones in early 2022 to mid 2022, they are likely coming due in early 2025 to mid 2025. Do you have also one of those bridge loans? I would say virtually all have them, right? Hopefully not all in the portfolio, but some certainly are. And how have you been able to deal with that?
Yes, one of the deals in our portfolio, the interest rate cap and the term expires in October 2024. So we are basically getting ready for that. The lender hasn't asked for us to put any reserve on the side. We do have cash reserves in place for that new purchase of the rate cap, following their forward curve, seeing where the interest rates will be in a year from now. So yeah, it's a struggle that a lot of syndicators have, and issues that's coming to fruition. The property has been performing excellent in our case. It's been at 95% occupancy. The rent growth has been above the pro forma projections that we've had. So the property is performing really well. It's just a matter of having enough funds in reserve for purchasing the rate cap relative to where the interest rates will be in a year from now. So we're in a decent position, and I wouldn't say it's by any means 100% allocated to our astute investing. I think luck plays a part in life and in business and everything else as well. We had another deal in Texas, which we were able to negotiate with the Houston Housing Authority and get a tax exemption. So that really saved the deal, and got us to extend our debt as well long term. I say that the situation really with where the interest rates are going and the distress coming to the market is affecting us more on our acquisition side of the business. As a newer boutique firm, we have a high burn rate when it comes to our salaries, when it comes to our costs for contractors, marketing, legal, compliance, and everything else. And when you haven't done a deal and you haven't made those asset management fees and those acquisition fees, it makes it very difficult to keep the company afloat. We haven't had done that deal in 18 months, and that just shows you it makes it very difficult. But we, one of our values is basically being risk averse, and for us, we rather not do a deal than to have done a deal and to have been making fees. We rather sitting on the sideline and just seeing where the interest rates were going, seeing what was happening with the economy. It just didn't make sense for us to get involved in a deal on purchasing a rate cap where it was going to expire, where we believe the interest rates probably wasn't going to come down. So it's affecting us more right now. We're wondering, when we're looking at deals to purchase in Jacksonville or Tampa, is it the right time? If the bottom of the market is the 6 p.m. on a clock, where are we at? Are we at 3 p.m.? Are we at 1 p.m.? Are we at 5 p.m.? Where is that bottom of the market? And it's difficult to always time the market, but getting somewhat of an understanding where we are. We also have a lot of supply coming to the market in both of those regions, both Jacksonville, Tampa, and other regions nationwide. When debt was basically free, a lot of developers got into the space and they start building. Mm-hmm. I mean, you always see this over history. I mean, when we look at deals in Jacksonville, they're either built in the 70s or they're built in the 2000s. And these waves come, and it's always relative on where demand was and where the interest rates was. And this is another wave that we're seeing right now, where interest rates were so low, a lot of developers got involved. Their fears that were there from GFC 2008 to 2011 were subsided, and they got back into the market and they start building lots. So, for example, Orlando is a market that we were looked at very closely, but we didn't want to get involved because just this year alone, there's 40,000 doors coming to the market. So, real estate is cyclical. We go through the cycles of, recession, recovery, hypersupply, and expansion. So, So it's recession, recovery, expansion, and hypersupply. So I would say currently we're in the hypersupply/recession phase of the market. So the question is, should we buy a B-class asset, which is approximately $1,500 a door, when you have thousands of doors coming to the market at sub $2,000 a door? Mm-hmm. Those tenants might have the opportunity to, go and rent something nicer for the price they're paying for a B-class property. So we're taking all of those things into account and figuring out, again, and also debt terms as well. Does it make sense to go in? What type of debt terms to use currently? Should we use agency? Should we use some sort of a fixed bridge? Should we use bridge debt? So those are really what we talk in-house here as a chief investment officers. Those are the conversations that we have every day for us to get involved in a deal in this stage of the company's growth. So those affects us more than the deals we've done so far. I think those deals are in good position. It's more about what to do going forward here.
Yeah, you made some excellent points there, right? Obviously, if you focus primarily on C-class properties, your competition from all that hyper supply, as you call it, in some markets from the A development space doesn't matter that much, right? But if you target B-class properties, that potentially compete with A-class properties, particularly if the developers are granting 2-3 months of concessions, and we have seen that in a number of markets. So now you only have 25% rebate on the advertised rent. So now you only get pretty close to a B-class property, right? So I fully understand that concern, and that's definitely something that I think a lot of buyers are not really recognizing, that if you have the massive supply in your submarket where you are looking to buy, that can actually upset your B-class occupancy and rents quite a bit. Well,
Exactly. And then on top of that, you got distress as well. You talked about $1.5 trillion of debt maturing here over the next year and a bit. So, a lot of groups can't, weather the storm. We know about a lot of different groups that are, in distress territory, either giving the keys back to the lender, or they're finding creative ways. But when we underwrote those deals that are coming to the market in distress, our price didn't even equate to the debt amount. It was millions below the debt amount. So we know that all the all the LP equity is being wiped out, and those non-recourse loans might turn into recourse loans. So overall, I mean, the debt markets are very logical. However, the equity markets are very emotional. So when investors do see distress coming to the market, that could be a nominal amount, but that affects them. That affects LPs, be it institutional LPs or retail LPs, when they're seeing that large groups are giving keys back to lenders, and LPs are losing money. They're standoffish, and it's not that easy to raise LP equity, especially in the syndication model. And if their deals are not being syndicated, there's less buyers, there's less demand. When there's less demand, prices come down, and with hyper supply, you got rents coming down. So currently, I wouldn't say we're in the best position for commercial real estate, including multifamily. And what I would say, again, my humble opinion, that things are definitely not getting better. They're for sure getting worse before they get better. So is how to weather the storm, is how to be conservative, but keeping the lights on as well. I mean, the famous saying these days is survive till 2025. Those are the times we're in, but that's what happens. It's the survival of the fittest in the business world.
Yes, definitely. I certainly agree with you. As you know, I've been talking about this for quite some time. I think we see, particularly in that bridge loan space, right, where a lot of syndicators are operating in, it's different, right? So when we talk about stress in the multifamily world, not everyone is going to be in distress, right? So the traditional institutional buyers that have historically always worked with 50 to 60% LTV and permanent financing, they are going to be fine in most instances, unless they just have operational issues. I would say the ones that are solely having significant issues over the next 12 to 24 months are the syndicators that were focusing on these so-called value-add deals were pushed to overpay thanks to the record low interest rates. And then on top of that, obviously also a lot of developers that just have all these construction loans coming due. You have a lot of concessions for all that inventory that comes online. And I think there are definitely quite a bit of opportunities there, right? So when it comes to the new construction, I believe we will see, but I believe that institutional investors will pick up quite a bit of that new construction inventory. I see not really any interest or very low interest from institutional side for the B and C class properties, right? So, but we have a significant distress there you already see it, we see it. So it will be very interesting to see who is actually picking up those deals. Everyone talks about all the dry powder on the side. Yes, the dry powder is there, but that dry powder is really there to pick up deals, right, at pennies on the dollar and
Pennies
not.
on a dollar. Yes, 100%.
Yeah, so it will definitely be very interesting how things are turning out over the next 12 to 24 months. So I congratulate you that you did not just buy just because you need to keep the lights on, right? As we know, a lot of syndicators have done that so that they earn their acquisition fees to keep the lights on, and now they are dealing with the consequences here. So that's so you're certainly in the right spot there. And I think you will have a lot of opportunities over the next 12 to 24 months, whether it's you or anyone else who has really the ability to buy properties. There will be plenty of opportunities out there, right? So the question definitely is, are we at the 3 o'clock? Are we 4, 5, or are we at the 6 o'clock? I do not believe that we are at the 6 o'clock at all, right?
No.
That's so it's only a question, are we at 5, 4, or 3? I would say that's really the question. And ultimately, whoever it is, right, you have to be sure that you buy a property where the numbers make sense for your model. And if the numbers make sense, hey, then buy the deal, right?
Yes. Yes. You talked about large institutions where they go in and they're doing, 60-40 LTV or even less than that. And these are large REITs in some cases because the cost of equity is so cheap.
Mm-hmm.
Their investors are looking at, they're happy with that, 5 to 10% average annualized returns, if that. And financial advisors and other portfolio managers are selling these investments to, investors all across the world. But in the case of syndicators, the most important number for us is our LP returns. That's the first number that we look at in our underwriting model. And then we receive the information from the broker. We put in the T12, we put in the whisper price, we put in all the other assumptions, their renovations, the CapEx, their rent growth. Well, everything starts with our LP returns. And that's what constitutes the price. So, that's at the end of the day, that's what builds a company. If you're able to achieve the LP returns in your pro forma and what you've promised your investors, not guarantee. This is not a business that you could guarantee. And if you ever hear guarantee, you should run the other way. But the projections you're making, the forecast you're making to your investors, and if you're not able to achieve that over and over, that's not the right firm to invest with. And that's why in our case, the numbers are just frankly not making sense for us.
Yeah, absolutely. Well, great discussion, August. How can our listeners be able to reach out to you?
Yeah, I mean, you can reach out to us at our website if you're looking to invest or learn more, cpicapital.ca. We have lots of great information, that a couple of ebooks on our website. You can reach out to me directly as well on LinkedIn. I'm very active, always put interesting polls and other information on there. You can connect with me if you want to have a discussion or talk about, possibly joint venture, or learn more about co-GPing or LP investing or any other information. August Biniaz on LinkedIn, pretty unique name. So sure, I'll pop up when you search for me.
Yeah, definitely. And anyone who is a Canadian investor, obviously, it's important to know you, right? Since you have the structure in place with for someone to invest from Canada without too much pain.
Exactly. If you're a U.S. syndicator sponsor, you're looking to bring on Canadian investors, get in touch with me. And my advice will be, don't do it. It's not worth the trouble.
Very good. Thanks again for being on, August.
Thank you. My pleasure. Thanks for having me.